Hi, everyone. We are almost at the top of the hour and we've got a lot of really great content to go through today. So I'm going to go ahead and get started. Hey, again, thank you for joining us today for this Ask the Experts webinar. I'm Allison Phillips, Director of Marketing on Cox Media's corporate team, and I'll be your host. Some quick housekeeping items before I introduce our guest expert. This presentation is being recorded. You'll receive an email with the recording so you can watch it again at your convenience or share with your teams. We have about 40 minutes of content prepared for you today with time for a brief Q&A at the end. But if at any time during the presentation you have a question, just go ahead and type it into the question box on your screen and we'll get to as many as we can at the end. So with that out of the way, I'm so excited to introduce you to today's guest expert, Jonathan Smoke. Jonathan leads Cox Automotive's Economic Industry Insights team, which tracks the economy, new and used vehicle sales, supply, prices, retail and fleet demand, consumer credit and auto financing, and dealer sentiment. So essentially everything you might need to understand key trends in the auto space. And all of it's informed by the proprietary data from Cox Automotive's many businesses and platforms. For more than 28 years, Jonathan has focused on translating data and trends into relevant, actionable insights, which is precisely why we've asked him to join us today. So with that, I'll hand it over to you, Jonathan.
Thank you, Allison. And, I'd love to say that we're at a point in time where my crystal ball is super sharp and clear. Things look very certain for the future, but as we have been living through for several years now, we keep having things happening in the economy and even in the auto market that make the immediate future a little uncertain. So I'm going to give you an update on everything that we're seeing that kind of fills in that story, and I'll end with sharing our outlook for where we think we're going from here, both in the short term and in the longer term. So starting right off, I like to start with the macro and focus on what we're seeing in the U.S. economy. And this is a good news, bad news story. The good news is that this year has been much stronger than expected. It has been widely discussed that we have been anticipating a recession. This is the most anticipated recession that has yet to occur. And in fact, I believe the odds of recession have been diminishing as this year has progressed. The third quarter, which we don't have official data on, but is represented by a forecast here on this chart, is likely the strongest quarter we've seen so far this year, likely above 3%. And what we see in the underlying data, even though the official data is not out yet, is that the third quarter saw a re-acceleration in consumer spending, and the consumer is represented of about 70% of the U.S. economy. So it's really what matters most. And we definitely have not seen evidence that the consumer has pulled back. But that said, the final quarter of the year is shaping up to potentially be the worst quarter of the year, and certainly to see further slowing than what we had been seeing in previous quarters earlier this year, as we have an unusual number of negative events and factors that I have no doubt will play some role in depressing consumer spending and consumer sentiment in the fourth quarter. A few of those things, the economy has been slowing generally from the incredible amount of monetary and credit tightening that the Fed has been overseeing. And even though we're getting close to the end of at least their rate increase cycle, there's lagged timeframes for fully seeing the effect of those changes, and that's still working its way through the economy. And then, of course, we have other negative factors that have just emerged, like the war in Israel, the strikes, in particular the UAW strike I'll be talking about today. But we've also had the reinstatement of student loans that is impacting at least some consumer sentiment and spending in the fourth quarter already. And then finally, we have the risk of a government shutdown for Thanksgiving. We managed to postpone it instead of it impacting the beginning of the quarter. But now, given the dysfunction in Congress, I'm not too comfortable with saying that we will avoid having a government shutdown as we get closer to Thanksgiving. But that's the good news, bad news, total mix. I'm now going to drill into some of the detail, and as it relates to the consumer, which is the most important part of keeping our economy moving forward in a positive direction, we have seen no evidence of the consumer pulling back. We get spending data on credit cards every week. It has about a 4-week lag, but we just got data through the end of September, and we're just not seeing evidence of the consumer pulling back. Consumer spending in total was up a robust 13% year over year on a nominal basis, with strength in categories like healthcare, travel, which has been booming all year, dining out, which has been strong all year and not pulling back. And earlier this year, we were seeing more categories that were negative on a year over year basis. But now that we're turning the corner on the final part of the third quarter and entering the fourth quarter, we're just not seeing as many categories down year over year. Vehicles is a category that's very broad. It includes parts, service, and even some vehicles being purchased on a credit card, although I don't know how many people have a credit limit that will let them buy an entire vehicle these days. But that was up a robust 14%, and it's a good proxy for what franchise dealers, for example, are experiencing, and they're continuing to experience a really strong market, just not quite as profitable as it has been the last couple of years. So the good news here is that the consumer is not pulling back. So where do we see challenges? Well, there's no question that inflation has been the main problem for the economy and specifically for consumers. And no question that inflation was high, particularly as high as it was last summer when we had the peak of inflation in June of last year. But we've seen inflation come down since then, as the main categories that were driving the inflation we experienced last year, food, energy, and housing, have been coming down. But when we look at the impact of inflation on different demographics, and here we're showing inflation's impact on 5 evenly sized income quintiles. So basically, the federal government gives us data that lets us understand where the income breaks are by household, and we know how spending by those households differs. So for example, the lowest income household, the one represented by the dark blue line here that has the highest inflation, are households that have incomes of under $30,000. And those households spend more than half of their monthly income on food, energy, and shelter, the very things that have had the most significant inflation. So when the headline inflation we reported a year ago at its peak in June was 9%, that dark blue line experienced 22% inflation. So why is that relevant? Well, we see evidence in the economy that we really have a bifurcated consumer story. Credit performance has been particularly weak for subprime in all types of loans, auto loans, credit cards, private loans, you name it. And in the car market, we have seen weakness in the used car market for almost 2 years now, but we've generally seen strength in new. And I would argue that's largely a story of the demographics behind who drives them and how inflation has been far more severe for lower income households than higher income households. In the last couple of months, unfortunately, inflation in general has been moving in the wrong direction, but that's been principally driven by a temporary increase in oil and gas prices that has already started to reverse in late September and into October. The war in Israel puts a little bit of a wild card on that, but I'm basing what we're seeing with gas prices so far in October that actually we'll see improvement. Plus, there are other categories that I'm very confident by the end of the year, inflation will be lower, not higher. So hopefully we will see a continuation of some of the improvement that we had earlier in the year. But the key message here is not every consumer is in the same financial position and able to buy because of buying power in the market. But one other characteristic that has changed, especially in the last several months, is that because inflation has come down and because we continue to see really strong wage growth, we're back into a scenario that most workers are seeing real wage or real income growth. So this chart is showing you what wage growth, what hourly earnings look like on a year-over-year basis in blue, but the red is showing you what that income growth looks like adjusted for inflation. So for the better part of the last 2 years, that number has been below zero, meaning at the end of the month, the typical worker was not finding themselves getting ahead. Instead, they were falling behind. But with inflation coming down, we turned the corner at the end of the spring, and every month since has been seeing positive real wage growth because earnings are growing faster than inflation. With the increase in inflation, it's not quite as strong the last 2 months as earlier in the summer, but it's still positive. And again, I think that's critical to understanding some of the improvement and change we've seen, for example, in the used vehicle market in recent months, which you'll see. But probably the most important factor backing up that the outlook for the economy is not bad is that we continue to have a really strong labor market. The only thing that potentially is going to change that is if we have a recession. And we don't think the probability of recession is more than 35%. It's still something that we can't eliminate. It's still something that I'm looking at on a scenario basis. But the good news here is if we see a recession unfolding, it will probably start in the fourth quarter. That's not the good news. But the good news is we will only see unemployment grow to 6%. And historically, that represents a very mild recession, one that is most similar. The last time we experienced a mild recession was in 2001. And actually, that was a recession that didn't even really show up in the auto market, meaning it didn't materially impact the number of vehicles being sold in either the new or used market. So it's one that the job losses will be fairly contained. It's not something as an economist that's focused on the consumer my entire career that I root for, but it's really one that we think could limit the kind of impact that we have. But that's not our assumption. Our assumption, the blue line, represents what we think is going to happen, and that is we're just going to see a modest increase in the unemployment rate, not because people are losing jobs, but because the labor force is expanding. And that's exactly what the Fed wants to see, an expanding labor force driven by population and particularly immigration adding to the workforce means that we have less pressure on wages and less pressure overall on inflation. So I believe very strongly that we can thread that needle and avoid a recession. However, we do have a sign that something's not quite right with the consumer, and that is in measures of consumer confidence and consumer sentiment. This chart is showing you the daily index of consumer sentiment for the last 2 years from Morning Consult. And the reason why I focused in on this is prior to the last 2 years, we saw 2 years of COVID really depressing consumer sentiment. But over the last 2 years, it's been more inversely correlated with inflation. And in particular, you can see a pretty decent correlation with gas prices here. So we were making good progress earlier in the year when that inflation story was improving, when other parts of the economy were starting to turn late spring and into the summer and picking up momentum. But then gas prices started going back up again in July and August and into the middle part of September. The good news is gas prices actually by the end of September were down, and now into October are down 7% year over year. So I'm rooting for that consumer sentiment turning around. Now, obviously, the war in Israel and other factors may be negatively weighing on consumer sentiment. But the reason why we focus on this is generally you see much stronger vehicle demand and other types of goods when consumers are feeling more confident about the future and consumer sentiment is high and improving. So we're keeping a watchful eye on that. Now, even if consumers were feeling great, it doesn't mean they're going to have the wherewithal to be able to buy. And so the next couple of slides are going to focus on the credit part of purchasing an automobile. So this chart is showing you our dealer track credit indices that we report on every month. It's basically a way through the eyes of the consumer to judge, is it hard or is it easy to get an auto loan? And another way to put it, are you getting a good loan or is it more expensive and harder to get. And basically what we've seen in those metrics was 2021 was a fantastic year to be able to get low interest rates, get easily approved, get the best terms available, and the consumer was able to afford a lot more. But since then, we've seen tightening in 2022 and into this year. When the banking crisis was happening in the spring, we really saw substantial further tightening in March and April. And where that's left us in recent months is it's more or less gone sideways. We've seen some months going up, some months going down, but generally we've trended sideways since the end of the spring. But relative to a year ago, relative to 2019, it is harder to get a loan today, and it limits who can buy in the auto market. And a big part of the change that we've seen has been a tremendous increase in interest rates. And unfortunately, this is one category that has continued to get worse in October, even with the Fed not doing more to increase official rate policy. So what we've basically seen is that the average new rate is approaching 10%, and the average used rate is approaching 14 and a quarter. And that is up substantially, causing the average monthly payment to be up roughly 15% compared to what we had pre-pandemic. So when you combine the rate increases with the increases in prices that have happened over the last couple of years, and you really see a dramatic impact on monthly payment. So that's illustrated here. We basically had record monthly payments over the last 12 months. The good news is we're not quite back to the peak. The new vehicle market had its highest payment last December, and it's generally been lower so far this year as new vehicle prices have come down. But unfortunately, because rates have been going up the last couple of months, we've been seeing it inch higher. The used car market is seeing better improvement in recent months because of declines in used car prices, which we'll look at. And actually, I think that's key to understanding why the used car market has had a better summer and fall than what we saw in the first half of the year. But ultimately, because of tighter credit and because of higher rates combined with higher prices, we actually have a portion of the population that really is priced out of the vehicle market, especially priced out of the new market. We believe at today's rates and prices that about 10% of the market that used to be able to buy in the new vehicle market is unable to buy in new. Now, they still need transportation. We're a country and an economy that's very dependent on personal transportation. So in most cases, it means those folks are really trying to buy used instead. But even there, we're seeing pressure as well because of the level of prices and rates. So we're kind of building up some pent-up demand, some people who've been priced out of the market and sitting on the sidelines. And I think with used car prices coming down in this summer, we're starting to see some of those people come back in, and that helps to explain a little bit of the positive momentum that we've had over the last couple of months in the used market. So let's take a look at what those trends have been for retail sales so far this year. We do weekly estimates of what the new retail market looks like and what used looks like, and we had two really different markets in the first half of the year. The new market has been strong all year and finally recovering off of multi-decade lows last year because of principally the lack of production and supply that has been improving all year long. So the yellow line on the left has been higher than the red line and maintained momentum, but kind of went sideways over the summer. But now that we've entered into the fall, we've seen an uptick in September and now into October. On the right-hand side is what the used market looked like, and the first half of the year was very disappointing. The yellow line did not go above the red line. It actually lost momentum in the traditionally most important part of the year, the spring, during tax refund season. Why was that? Well, tax refunds were down. As I mentioned earlier, credit tightened pretty abruptly during the banking crisis. So March and April saw used interest rates move by almost a full percentage point in a single month. And that really just worked against consumers combined with some of the higher inflation that was happening that time of the year. But you can see that the yellow line actually started to improve in the summer. and we started to see the yellow line get even with the red and actually move ahead of the red, and that has continued to be the case so far into October. And I think the key to that has been that because used vehicle prices have been declining and the economy continues to be strong and consumers have good income gains, that you're finally seeing some consumers able to buy that haven't been able to buy the last couple of years. So it's largely a story of the market starting to normalize. But speaking of normalize, on the supply side, we're pretty constrained in both new and used. Generally, this year has been a story of it's new inventory that's been improving and used inventory has been very tight. In the new market, we finally have close to 2.3 million units when we were down to the lows of about 1 million. I'm showing day supply here, which takes the inventory and adjusts it for the sales pace to tell you how long that inventory will last. And we've basically seen day supply go sideways to slightly higher this year. And that's a good sign that the increases in inventory are largely being absorbed. We have had robust demand that's helping to keep it that way. We're going to see one pocket of the market that's not quite that way, but overall a good indication that we certainly are not oversupplied. We're still constrained relative to, say, 2019, our last normal year. But the used vehicle market has been constrained all year, down in terms of day supply. This has been driven by two things. One, dealers have been very diligent about keeping their inventories lean. It costs them much more money now with higher interest rates to hold inventory, so they've generally kept their inventory lean. They're focusing on turning inventory much more rapidly, and we really see no evidence of supply building up. And if anything, over the last 2 months, as the pace of sales has been improving, we've seen supply tighten a bit. And the same is true in the wholesale market. The other issue that is constraining what's possible in used is, as you'll see in a moment, we have a lack of new vehicles that were produced the last several years, and that always limits the used car market in a recovery period. So we are constrained in both the new and used market on the supply side. However, because the new market has been changing, the price dynamics have been changing. There's no question that 2021 was sort of the peak of ultimate pricing power for anyone who was selling vehicles as opposed to buying vehicles. These are two of my favorite metrics to track. The green is looking at incentives that manufacturers are spending in order to sell vehicles relative to the vehicle price. That fell to an all-time low early in 2022 and has been growing pretty aggressively since. In September, with the start of the UAW strike, it was our first month in more than a year that we didn't see growth in incentives. Effectively, incentives just went sideways in September. The red line is measuring the average transaction price relative to the invoice. So it's a pretty good proxy for the margins that franchise dealers are seeing on new vehicles. So you can see that that number has come down from the peak of profitability in early 2022, but it is still really higher than it was before. So, you know, it's a good sign for those of you who are selling to franchise dealers. They are simply going to have their third most profitable year in history, and they're still enjoying very positive pricing dynamics, and one that is likely to be more positive for them for at least another year or two as we start to see supply conditions further improve and normalize. But the improvement has actually improved affordability, though it may seem hard to believe that affordability has been improving with interest rates going up. That is true, because affordability is really a function of three things: the income, which we went over earlier, that individuals and households are enjoying actually above average income growth, and that continues. We have seen interest rates go up, so that offsets that a little bit, but prices in both new and used have come down, and as a result, affordability has been improving. And to me, that's really key to the incremental demand that we're going to see coming into both the new and the used market over the next couple of months. So it reinforces my view, especially if we're close to the end of rates increasing no more, peaking, and then eventually coming down. We will see even greater affordability down the road and opening up more people who are able to buy. But we're not seeing this rising tide in the new vehicle market lift every brand boat. This has been an interesting contrasting year for brands that are gaining in share versus brands that are losing share. This is showing you the year-to-date share change by brand in the new vehicle market. And in the green are largely the brands that are seeing the ability to deliver more vehicles. So all of their supply chain problems and production problems are behind them. And they also have consumers that are in good shape and able to sell. So Toyota really had a turnaround. They were one of the brands. A lot of Japanese brands were continuing to have problems with their supply chains and semiconductors last year, even though other brands like from Europe and North America were seeing improving conditions. Toyota actually continued to have production problems in the first half of the year, and that's why we see them in the red column. But actually, if you look at the presentations I've done every month this year, Toyota was in way worse shape a few months ago and has really been seeing improvement on their share loss year over year. In fact, they are one of the handful of brands that is benefiting now from the challenges that the Detroit 3 have with the UAW strike, because they're hitting their peak in getting back to full capacity on production at the perfect time to be able to sell in the marketplace. There's a few others that I would call out in the red on the right. The Stellantis brands, Jeep and Ram, are currently impacted by the strike, but actually a lot of their performance issue in losing share was clearly evident earlier in the year, as was Ford, and we think a lot of that was anticipating having to deal with the strike and not being as aggressive with incentives and the like, so that they would have supply to be able to last through a typical strike. So there's no question this either preparing for or now dealing with the strike is playing a role with some of the differences we see in brand. The other thing that I would call out is we are seeing evidence of credit challenges also influencing some brands that aren't doing as well this year. So for example, Jeep, Mitsubishi, Dodge, those are brands that often have a lower credit quality consumer, more subprime in their traditional pool, and those are the very people who are most likely to be priced out of the market that I shared earlier. So you've got a real mixture that influences which stores are likely to be successful and which are seeing more challenges. Another factor that hasn't fully normalized yet is the level of leasing activity. So we look at lease penetration, what percentage of retail sales are actually leases. And back before the pandemic, we were around 30% of the overall market, about 50% of the luxury market. And we really saw that collapse over the last couple of years. And mainly it's because lease offers just haven't been attractive. So consumers have walked away from the idea of leasing. In fact, I think many of them have ended up buying with cash instead. And so that has implications on the used vehicle market that we're already starting to experience that I'll show you in a second. We were starting to see lease penetration improve earlier in the year. The last couple of months have moved in the wrong direction. And some of that has to do with the anticipation that supply was going to tighten again with UAW disruptions. But we have faith down the road that leasing is going to be a bigger part of the market. And one area where we are seeing improvement in the near term is leasing related to electric vehicle sales. So in fact, the next couple of slides I have are about the electric vehicle market. This is where the most dramatic growth is happening. This is where a lot of marketing and spend is going to be focused. And indeed, we're seeing tremendous growth year over year in electric vehicle sales. The third quarter had over 300,000 pure battery electric vehicles sold in the US. That saw the share get up to 8%. And sometime this quarter, possibly as early as October, we're going to cross the 1 million unit threshold for the first time in the US for a single year to sell that many battery electrics. The market is enjoying several different kind of tailwinds, including government policies that are encouraging adoption, that are pushing the fuel efficiency standards higher, that are causing manufacturers to plan more electric vehicles coming. We also have a tremendous amount of incentives, both on the consumer side with the Inflation Reduction Act, but also on the manufacturing side that compensates them, that pays them for every battery electric that is being delivered with a US battery in it. So all of those things are really causing the supply to build up and lead to more EV sales and more consumer adoption. Plus, we're seeing more variety in the products that are being offered, and that gives consumers more choice. And we think down the road will be driving even greater adoption. Some of the evidence of the change happening is looking at how the shares are changing. We still don't have every brand represented, but over the next 2 years, every brand will have at least one offering, if not more. Tesla has been the dominant player, and they will continue to be dominant, but they are going to be losing share as more traditional brands and new entrants like Rivian come into the market. So it's going to be a very dynamic, all-encompassing sort of world. But we're not seeing success the same way all across the country. Sales are anything but uniform. There are basically markets or states with sales, and there are those with not many sales. It's probably no surprise to anyone on the call that the greatest adoption has been in California, and then more broadly in the West Coast. We've got a couple of pockets on the East Coast that have really started to improve, especially over the last couple of years. You've got differences in state and local incentives. You've got differences in the existence of the charging infrastructure. You've got differing emission regulations and targets. So you have California with their CARB standards, and you've got a handful of states following California that largely explain some of the differences we see here. But you also have differences in approach by the manufacturers on which states they are focusing on and allocating EVs to. And so all of those play out to very different regional differences. And even within states, you see big differences between urban areas and suburban and rural areas. So we think this is going to continue, but gradually over time, obviously, if we have more sales, we will be seeing more progress made in sort of middle America or with the average American. But one characteristic that is really standing out of this year's performance so far is that even though sales are up 80% by the end of the third quarter, we're actually seeing supply up by almost 300%. So all of those incentives, all of those regulatory influences are leading to a pipeline that is delivering more vehicles than the market can currently absorb. And I believe, based on what's in the pipeline, that I'll show you the forecast right at the end, that we are likely to be in an oversupplied case for the foreseeable future. So as an economist, what can I predict that's going to happen from this is we are going to see lower prices for electric vehicles. We're already seeing electric vehicles decline year over year in pricing by about 20%. Some of that is because price cuts and incentives, and Tesla has been aggressively cutting prices all year. But it's also because we're seeing more manufacturers focus on newer form factors and cheaper vehicles than the more luxury focus that has exists. So the number one issue holding back consumers from considering a battery electric vehicle is price. And pricing is going to come down. So we think more and more people will consider it. And within a couple of years, we will be at a point that the average EV will actually be the cheapest vehicle available. And we think adoption will continue to grow when we finally get to that point. However, one part of the market, in the used market, so shifting gears, where we're not oversupplied, in fact, we're constrained, is the used vehicle market. On the left is a picture of what the car park looks like, or the vehicles in operation by model year. And you can basically see the Great Recession impact. That's why we have those lower numbers from 2008 through 2011. But now you've jumped to the most recent years, and we basically have a much lower volume of vehicles made in 2020 through 2022. And as a result, that means that the hardest to find vehicles are vehicles that are less than 4 years of age. And as a result, used retail sales, all of the growth that's happening is in older vehicles, and namely so far, vehicles that are 9 to 12 years of age and 17 plus. So that creates a dynamic that there's intense competition for wholesale vehicles and used vehicles to feed the retail market, and is one that is causing some channels in the used car market to have a more difficult year. So for example, Carvana, CarMax, which had been growing gangbusters, have not had a good last couple of years. And the supply is going to influence what's possible. Now you would think if nearly new vehicles are constrained, then certified pre-owned has to be down, but no, certified pre-owned is actually the strongest part of the used car market. Year to date up 8%. And so you might wonder, how is that possible? Well, the secret has been manufacturers have expanded program eligibility, which means they're allowing older vehicles and vehicles with higher mileage to be used. That's helping them sort of control for the limited supply. It's also clearly evidence that there's strong demand. If affordability is limiting the new market, a certified pre-owned is the best alternative to a new vehicle, and it often brings finance and warranty benefits. So we think the certified pre-owned is going to continue to be a strong part of the market. So what has the used car market look like in terms of prices? Well, we've had some rounds of prices going up. We started the year with wholesale prices going up, and soon thereafter retail prices followed. So the gray line here is showing you model year 2020, how prices look week by week relative to how they started the year. But then wholesale prices really started to come down strongly in the spring. That created the ability for retail prices to soon follow, and retail prices have been falling fairly consistently all summer long, creating more affordable vehicles out in the market for consumers who've been priced out to get into. The uptick in retail demand that we had this summer caused wholesale prices to go up temporarily in August and part of September. But now that we've wrapped up September and entered October, we've seen wholesale prices normalize again and are coming down. Going forward, with the exception of maybe some risk later this fall from the UAW strike, if it continues to go on, we think prices are going to return to more normal trends. So we are assuming from this point forward, we're mainly going to see normal depreciation. And that means that affordability will just improve in the used car market for each week and month practically going forward. And once we add lower interest rates and easier credit, once we're a little bit further along in this rate cycle, then hopefully affordability will really improve. And one other area that I wanted to share, if any of you are focused on dealers who are taking care of consumers in the service department, generally the service department has seen really strong performance over the last couple of years. It's interesting, we use our Xtime platform to look at 3 metrics here. The metric that hasn't recovered to 2019 is the orange one. It's the number of tickets that dealers are seeing, or think about the number of service appointments that they're seeing. We've yet to recover to 2019 levels. And a lot of that has to do with the car park and the lack of nearly new vehicles, because it's typically the younger vehicles that are more likely to be the focus of marketing for dealers, and as a result, they just don't have as many customers. But when the customers are coming in, the gray line has been telling us that they've been doing more work, plus dealers have enjoyed pricing power. That basically means the revenues off of the tickets, the blue line, has been steadily growing and showing really strong growth year over year. September was the first month in more than 2 years that we had a downturn in all 3 metrics. And we're digging into it to see if maybe the strikes in week 2 of the strikes, as you'll see in a second, we really saw the UAW focus on parts and distribution centers, especially for GM and Stellantis. And so one hypothesis is that potentially that started to impact what's happening in the service lanes. So other than the car park and the possibility of disruption, we're pretty bullish on what we're expecting to happen in the service department, because dealers are enjoying pricing power. The average vehicle is getting much older, and the consumer is wanting to hold on and maintain their vehicles for longer because of affordability challenges. So it generally is an area that should be continuing to be strong for dealers. And I would say our outlook for vehicle sales is also very bullish, because we think the worst is over in every channel. And what we're projecting to happen over the next 5 years is pretty consistent growth. Now, I would describe it as growth that is constrained, because it's constrained by what's possible in production and supply. In the near term, we're dealing with challenges like with the UAW strike, but we're also seeing the shift to electrification that's happening, that's changing some of the capacity in the marketplace. The used market is limited by what we haven't produced over the last couple of years. So all of those things basically mean it takes us to getting to 2028 to have full recovery on the volumes that we had in 2019. But that will come. It's just a function of time. Now, of course, over this time, we're going to see a tremendous shift to electrification. So that ramp up in models and production and volumes will continue. This is a supply-oriented view of what could happen. It's data from S&P where they take what the manufacturers are planning and they forecast what that would imply. So in green, I'm showing the pure battery electrics. In blue, it's the hybrids. That basically tells us that by 2026, if you add them together, that's half of the new vehicle market. And that's pretty dramatic growth. And I have pretty strong confidence that the volumes we're going to see are probably going to be very close to what is forecasted here. I think, though, we're probably going to see more and more announcements with adoption kind of causing problems, with the UAW strike causing the domestics to rethink some of the volumes that they aggressively were even planning for next year. We're probably going to see hybrids peak a little bit further out and stay there for a while. We're probably not going to quite hit the president's target of 50% by 2030, but it's inevitable that we're moving in this direction because of global focus on energy efficiency and the regulations that are coming from the federal government, plus the incentives in the IRA will be in place for the next decade to also encourage the adoption. Now, I mentioned a couple of times the UAW strike. Basically, here's the timeline, unless something happened since we started the call. The most recent sort of action, this has not been your typical strike. One, for the first time in history, all three of the major domestic brands have had the UAW strike against them, but they've kept it very targeted and limited. So up until now, with the strike having lasted a full month, we've lost about 155,000 vehicles that we otherwise would have lost. But to give you a frame of reference, had we had the UAW strike every factory from day one, we would have lost about that many vehicles per week. So the impact in September was largely negligible. In fact, new vehicle sales increased in September, as did the inventory levels. And the way that that's possible is that the other brands stepped up. So in particular, Toyota, Honda, Nissan, Hyundai, all really saw improvement, and that was key to that happening. Now, if the scope continues to expand, and we anticipate there could be another factory announced any day now for GM and possibly Stellantis or both, then you're starting to get to the heart of the market. Like last week's announcement was against Ford's most profitable truck plant. And so we're starting to see numbers that will have more of an impact. So simply put, we think the disruptions will have more of an impact and will start showing up in sales and pricing later in October. And if this persists into November, there's no question that a disruption as far as Thanksgiving would absolutely lead to supply tightening substantially in the fourth quarter, by the end of the fourth quarter, with prices increasing in new and used, and sales potentially ending the year on a weaker front. And that potentially means manufacturers and dealers possibly pulling back on advertising, thinking about used a little bit more, particularly for those brands. But ultimately, we believe that it's temporary, and once we get resolution, we will start to see a return to the recovery. So it's just a sort of temporary pause in the recovery that we've seen. So that brings me to the final slides, which is just giving you a recap on our forecasts for the year. It's been a really strong year for new vehicle sales. We've upgraded our forecast multiple times, and we're pretty confident that this is how the year is going to end. The used car market is where there's been weakness, but really we've recently upgraded our used car forecast by about 200,000 units. And as I mentioned earlier, the certified pre-owned has really been the strongest part of the market. And the view of what vehicle values are going to be are largely what's already happened. We're really expecting normal depreciation from this point forward. In fact, as a contrast, looking at next year, that decline in vehicle prices is actually an increase. A normal year, our last normal year for the Manheim Index saw used vehicle values go up 2.5%. So we're expecting a pretty normal year as it relates to depreciation and what's happening with vehicle prices. We think affordability plus the lingering impacts of the UAW strike and what's done to kind of conform to those, we think is going to put a lid on some of the growth that we've seen in the new vehicle market, with most of it being on the fleet side. But next year starts the recovery across multiple years of the used vehicle market, and we'll continue to see strength in certified pre-owned, but it'll be limited by what's possible. So that's all of the content that I had prepared. Allison, if you want to help me navigate the questions that we've had coming in, I'm happy to move to that now.
Yeah, absolutely. Thank you, Jonathan. That was for someone who's not in the auto industry, but in a business that serves auto industry, that was fascinating. So thank you for that. So we do have a few minutes for some questions. I know some of you submitted questions when you registered for this webinar, so we'll start with those. But if you have a question you'd like to ask Jonathan, go ahead and submit it through the question box on your screen. All right, Jonathan, the first question we got was, do you think there's a chance that the EV market could slow once there's a new president in office?
Yeah, it is definitely a risk. As I mentioned, a lot of the reasons why we're seeing such a ramp up in production plans and growth is because of both regulations and credits. I think it's going to be difficult to completely slow down the train. The train is leaving the station, and a lot of what's happening in the US is consistent, if not behind, what's happening globally. And I don't think a change in administration is likely to reverse everything. I think it's possible that some of the credits could be pulled back, and that would slow some of the pace. I think really in the near term, I'm more concerned about consumer adoption and really trying to find the solution that really works for consumers that are not the eager beavers, the early adopters. The selling to the choir has really been who's bought so far, and we're now seeing manufacturers and dealers have to contend with convincing consumers that maybe are open to it and are considering it, but they're not yet really pulling the trigger on it. So it's more about cost, and I shared I'm confident the price is going to come down, but I also think that things like the charging networks, like more experience for how batteries last and how they perform, how you judge health, all of those things are really a learning curve that the whole industry and consumers are going to have to go through. And one thing we see consistently in the research is consumers are expecting dealers to have all the answers, and dealers have their own education to go through to be able to do that. And so it's going to be an interesting decade, no question.
Yeah, thank you. How long do you think Americans will continue to spend so much of their savings and increase their debt at the pace they're going? Do you expect that a crash of some kind is inevitable, or do you think it can be avoided?
I don't think a crash is inevitable, because I would argue that when you look at the health of the consumer across every metric, it is a mixed picture. We don't see anything that sets off alarm bells. For example, I was a housing economist in 2006, and there were alarm bells ringing before the 2008 recession, the Great Recession began. And on a nominal basis, yeah, you can hear numbers that say we have record debt, but on an inflation adjusted per person basis, that is not true. And actually for, you know, households that are above median income that tend to be homeowners, they actually are in the best financial position that we've seen in the kind of history of robust data. Why? Because they've fixed in the majority of their debt is mortgage debt that is under 3%. They are enjoying strong income gains and not being as negatively impacted from inflation because their housing costs are low and fairly limited. It's really not a story that we have all consumers on the edge. Where we have stress, renters, lower income consumers, that's where you see pain in the businesses that cater to those consumers. That's why we've seen more challenges in used. But the good news there, you know, some of the challenges are abated a bit, and it's possible for the consumers to navigate because they have jobs and because they see strong opportunities. You know, we have 1.5 job openings for every unemployed person. And historically, that ratio has always been below 1. So this is truly a good time. And, you know, another positive story for the lower income worker is the lowest wage workers actually are seeing the strongest income gains. They have the most bargaining power. So it's not decidedly a positive story, but it's just not decidedly a negative story that a crash is imminent. And so I think we can navigate this.
Awesome. Well, that's a relief. How does the used car market and increases in interest rates impact auto repair shops?
Well, two things I think are really powering strong performance in auto repair shops, be it franchise-owned ones or independents. One is because it's more expensive and harder to get a new vehicle, more people are holding their existing vehicle. And two, vehicles are lasting longer. We've got the oldest car park, 12.6 years, according to the latest from S&P. And so as a result, they're at the age that they have to do more work to maintain them. So, and then, you know, what is being sold has seen higher than normal inflation in terms of parts. And then where there's a labor component, there's limited capacity. It's hard to hire those technicians. That's the hardest part in the industry to fill open jobs. So as a result, there's been strong labor cost increases too. So I would say the outlook for parts and services is strong for the foreseeable future. A lot of people worry about, will electrification change that? I think over the longer term, you know, time will tell, but what we see in the near term is actually electric vehicles have more problems that tend to be covered by warranties, so it's really not the consumer's issue, and they're more expensive vehicles with more complex software and other sensors and the like that tend to, you know, when there's a minor accident, it's a bigger expense. And so you put all those things together and it basically says parts and service is going to be doing just fine for the foreseeable future.
Yeah, still service, just a different kind of service for EV vehicles.
That's right. And by the way, when you forecast the change in EV sales over time, the car park is changing much more slowly. So the most aggressive view of the future says we could get to 80% battery electrics sold in the new market, so 80% share by 2040. I hope I'm retired by then, but 2040. If we do that, about 1/3 of the car park will be battery electric. And so parts and service is going to be dealing with both types of powertrains for the foreseeable future, and it's certainly not something that's going to change overnight.
Yeah. What would your advice be to automotive marketing executives heading into 2024? General advice.
Oh, well, one is to be aware of sort of the short-term cycle risk. There's no question that this fourth quarter is going to be, you know, the hardest one to navigate with the UAW strike. If you're representing brands that are tied to those, you've got different issues than others. The second is the longer term view is strong. We are entering a period of likely growth in every channel for the next several years. So be prepared that growth is ahead. So don't do anything in the short term that's going to compromise that. We definitely have to be aware of the shift to electrification, as we were talking about. That's going to be a major place where we're going to struggle to sell those vehicles. We're going to have to advertise more. We're going to have to focus on a lot of education. So a lot of a different kind of advertising, I think, is going to be necessary because of that. And then the final piece, which I didn't really talk about too much other than the EV adoption today, is that where you are in the country is going to also greatly influence what's happening. If we do run into a recession, there will be parts of the country that will have no recession. And the recession will be more felt in other places of the country. So, as an economist that does a lot of national reporting, but I came from the housing world, pay attention to your local market. Chances are what's going on around you may be very different from the national story. And I can't always advise on where to get that sort of local data, but usually people know their universities or Chamber of Commerce or other places that help them truly track what's going on in their market. But the nature of what we're going through suggests that we'll have some pretty sizable regional differences.
Yeah, okay. I think we have time for one last question, and it's about electric vehicles. Do you think that infrastructure will grow fast enough to accommodate EV sales? And in that chart you showed, is that contingent on infrastructure growing at a similar pace?
It's definitely a chicken and egg issue. So I am positive that as there are more EVs, it will be profitable for more businesses to consider having chargers and operate charging networks over time. And we can see in the data that where penetration has been strongest, like in California, you tend to have more chargers. So I'm optimistic that that problem will slowly resolve itself. But also with somebody that's getting experience with dealing with electric vehicles, I can say that I really don't think charging infrastructure is the number one issue. I personally believe that the use case for an EV is strongest from a personal economic standpoint when you can charge at home. And so it's really an issue of educating people on, do you have a garage? Can you put a power line in your garage to be able to charge overnight? And if that's the case, and you're principally driving in town to and from work, to and from your kids' school, those kinds of things, it actually, when would you ever need charging infrastructure? Yes, road trips, but that's also where I think maybe the typical household doesn't have all EVs. They have one car that they take on a road trip, and they have another car that is more that car that is used in town. So I think there's a lot of learning that we're going to do, and I don't think the infrastructure is the key issue in the short term for a lot of folks.
Yeah, we're one of those households, so I can relate to that. All right, well, Jonathan, again, thank you so much. That is all the time we have for today. As a quick reminder, a recording of today's webinar will be emailed to you, and we'll be back again later this year with another guest expert and more great content. So we hope you'll be able to join us again then. In the meantime, check out our website, coxmedia.com, for articles, ebooks, and recordings of some of our previous Ask the Experts webinars. And as always, for any additional questions regarding today's content, please contact your Cox Media consultant. If you're not a current customer, you can visit coxmedia.com to connect with one of our media experts. So thank you all again, and Jonathan, again, thank you so much. We look forward to seeing everyone next time. Have a good one.